Alright, let's hit the movers board. Because the index tape is basically asleep, but this small cap board is absolutely not. SPY flat, QQQ slightly red, IWM down about 4/10, mixed breadth. And then you've got SCKT up 425%. That is not normal tape. JWEL up 205%. STKH up 100%. Then the other side of the board is nasty too. SION down almost 90%, TENX down 86%. So this is the market's desk right now. We're not chasing headlines, we're checking volume, float, and whether these things can actually hold a level once liquidity shows up. Alright, let's pull up SCKT. This is the wild one off the open board. Oof, look at that wick. Market's basically sleepy. SPY flat, QQQ a little red, and this thing was showing up over 400% on the movers board around $2. The 1 minute is the whole story. Dead base early, 37 to 41 cents, then boom, volume hits. Price rips through that old 41-cent ceiling, tags almost $3.97, and now it's trying to live back around $1.94 to $2.03. For the market's desk, the line is simple. Watch the $2 area from above. If it can't hold that after a parabolic squeeze, these can turn into elevator candles fast. Now the catalyst. Let's go to the headline. Socket Mobile put out a 9 a.m. press release. Partnership with 3i Technologies to expand industrial mobility solutions for Apple-based frontline operations. So that's the story traders are attaching to it. It's not some mega-cap earnings reset. This is a tiny computer hardware name, barcode scanners, RFID, mobile data capture, and the float listed here is only about 534,000 shares. That's why the candle looks insane. Tiny float plus fresh headline plus pre-market liquidity equals air pockets both ways. And yeah, before anyone gets hypnotized by the green candle, check the dilution page. This matters on small caps. SCKT shows medium dilution risk, 4 active shelves, an active equity line, and about $2 million raised over the last 12 months. Runway is listed around 16 months, but the offering history is not nothing, 24 total offerings. So I'm treating this like a momentum vehicle, not a clean fundamental breakout. Respect the volume, respect the $2 line, but don't confuse a parabolic low float move with safety.
Thanks. Market's desk. Let's shift this into the AI stack, because NVIDIA is still the name that decides whether this theme has real bid or just headline noise. NVDA is sitting around 222.96 in the data we've got, off about 0.4%. And that matters because the tape is basically mixed. SPY flat, QQQ down a tenth, IWM a little heavier. So here at the company desk, I'm not asking is AI hot? Everybody knows the story. I'm asking the better question. What actually changed over the weekend that changes demand, margins, or the competitive map? Okay, now the fresh NVIDIA news flow is interesting because it's not one clean company announcement from NVIDIA itself. It's the ecosystem talking around NVIDIA. We've got one story framing NVIDIA as turning AI complexity into a moat. Compute, networking, memory, software, the whole system architecture. That is the bull case in one sentence. NVIDIA is not just selling chips. It's becoming the operating layer for AI infrastructure. But then you've also got the more skeptical angle. Mark Cuban comparing parts of the AI ecosystem to the dot-com era, with NVIDIA funding or supporting a lot of adjacent players. That doesn't mean the sales are fake, but it does mean the market is going to care about how clean the end demand really is. And look at the press release trail underneath that. Cumulus AI is talking about access to NVIDIA Blackwell GPU capacity for an agentic hedge fund. Zayo is building more than 8,000 miles of long-haul fiber tied to AI factory demand. AZIO is referencing up to 128 NVIDIA HGX B300 systems, with an estimated hardware value around $77 million. That's the key distinction. These are demand signals around the NVIDIA universe, not NVIDIA reporting a fresh quarter this morning. So if NVDA pushes back above roughly 223 and holds it after the open, that tells us the market is willing to treat the ecosystem headlines as support. If it can't, then maybe the stock is saying, nice story, show me orders and earnings. Now, Rotate that into Broadcom, AVGO, because this is usually where you find out if the AI trade is broadening or if it's just NVIDIA dragging the room. Broadcom is the custom silicon and infrastructure proxy in this group. Not the same business, not the same multiple, but it lives off the same question. Are hyperscalers still spending aggressively on AI build-out? I don't have a fresh Broadcom catalyst in this packet, so I'm treating this as confirmation. If AVGO is firm, while QQQ is slightly red, that's a real tell. If it lags NVIDIA badly, then the AI bid is narrower than the headline story sounds. Marvell is the more sensitive read for me. MRVL tends to trade like a higher beta AI infrastructure name. Networking, custom silicon exposure. The stuff that benefits if the build-out keeps spreading beyond the biggest platforms. But it's also less forgiving. When the tape is mixed and VIX is still around 20, the market doesn't usually reward second-tier AI stories unless the bid is actually there. So on MRVL, I'm watching the character of the open more than any one headline. Does volume confirm? Does it hold green? Or does it just pop and fade with the group? And then, AMD is the cleanest competitive question in the basket. If the AI CapEx cycle is broad, and customers really want a second source, AMD should at least participate when NVIDIA headlines are strong. If AMD can't get traction on an AI tape, that tells you the market still sees NVIDIA as the toll booth and everyone else as optionality. That's the story arc this morning. NVIDIA has the ecosystem, Broadcom confirms infrastructure spend, Marvell checks the higher beta appetite, and AMD tells us whether the market believes the accelerator pie is widening. Coming up, we've got the news intermission on deck, so we'll keep tying the headlines back to what's actually moving. All right, let's move from those wild little pre-market runners into the big AI compute chain, because this is where the real market cap gravity lives. Here at the company desk, NVDA is the first stop. Stocks around 222.96 in the data, down about 0.4, while QQQ is only down a touch, so it's not getting smoked, but it is lagging the tape a bit. And the big reference up top is still that 236.54 year-high area. That's the line that tells you whether AI leadership is actually expanding again or just digesting. Now, the reason NVDA matters in this theme is not just, quote, they sell chips. That's too simple now. The fresh headline stack is all about NVIDIA as the system architect. Compute, networking, capacity, software, the whole thing. We've got headlines around Blackwell GPU capacity, Zayo building network capacity for AI factories, and AZIO talking about up to 128 NVIDIA HGX B300 systems with an estimated hardware value around $77 million, subject to future orders and conditions. That last caveat matters. A pipeline is not the same thing as booked revenue. But the story arc is clear. Demand is moving from individual accelerators to full AI infrastructure buildouts. But here's the skeptical part, and this is the part I care about at the company desk. What does this actually change? There's also that markcubanstyle.com comparison floating around, basically asking whether NVIDIA's ecosystem investments are creating durable demand, or whether investors should worry about circular demand inside AI. That's a fair question. The data we have doesn't prove NVIDIA is financing its own sales. But it does remind you that when a company becomes the center of the ecosystem, every partnership headline needs to be separated into two buckets: real customer demand or just strategic positioning. Let's rotate to AVGO, because Broadcom is the cleanest way to test whether the market is buying the broader AI infrastructure idea, not just the NVIDIA-specific moat story. I don't have a fresh AVGO catalyst packet in front of me here, so I'm not going to make up a headline. The business read is simple though: custom AI silicon, networking, and hyperscale exposure. If the AI trade is healthy, this name usually stays in the conversation. If NVDA is the only one getting attention, then the theme is narrower than the headlines make it sound. MRVL is a different flavor of the same theme. This is more data center plumbing, connectivity, custom silicon exposure, not the celebrity AI name, but still part of the chain. And that's why it's useful on a day like this. With the indices mixed, SPY flattish, QQQ slightly red, I want to know whether second-tier AI infrastructure names are being pulled higher by the NVIDIA narrative, or just sitting there waiting for their own numbers. For MRVL, the market usually wants proof, orders, margin impact, timing. Vague AI language is not enough anymore. And then, AMD is the competitive read. This is where the theme gets interesting. If investors think NVIDIA's lead is just getting stronger, AMD can get treated like the challenger that still has to prove share gains. If the market decides AI demand is big enough for multiple winners, AMD can start catching sympathy as the alternate compute play. So that's the map. NVDA is the architect. AVGO is custom silicon and networking. MRVL is the infrastructure sensitivity. AMD is the competitive pressure gauge. Coming up, we'll kick it back to the movers board and see if the pre-market tape is still chasing those high-volume runners.
Thanks, Company Desk. Let's snap right back to the movers board. Alright, this board is still wild. Tape is basically mixed. SPY barely red, QQQ barely red, IWM down 0.4. So when you've got single names doing plus 500, plus 150, minus 90, that's not market beta. That's event tape. SCKT still number one, 240-ish, up 530%, and the relative volume is just absurd at 1,500 times. JWEL, scoreboard update. That 450 level we flagged earlier, it got tagged to the downside. Now it's sitting around $4, so that one is no longer clean strength. That's a prove-it chart. STKH still doubled, AUUD up almost 70, and then the ugly side, SION down about 90%, 10X down 86. Oof, those are not dips, those are damage charts. Let's go one by one now. 1-minute candles, no wasting time. Starting with SCKT, because yeah, this is still the main character on the board. Look at the math first. $2.44, up 530%, 40 million shares already, on a float around 534,000. That is how you get these violent candles. This is not normal liquidity. Here at the markets desk, the score stays simple. Earlier we marked $2 as the big danger line, and it's still above that for now. But tighter, right here, I'm watching 250. If it can reclaim 250 and actually hold bid above it, buyers are still pressing. If it keeps rejecting under that area, then the parabolic move starts turning into chop. And chop on a float this small can get nasty fast. Low float, medium dilution risk, huge volume, fun to chart, dangerous to chase.
Thanks, Markets Desk. Okay, quick bell countdown from the macro desk because the opening print is basically minutes away and the tape is doing that fake calm thing. SPY sitting around 772.84, down just 0.05%. QQQ is around 722.51, down 0.07%. VIX is 20.25 and actually a touch lower. So on the surface, not much drama. But look underneath. IWM is the tell here, 300.37, down 0.39%. Mega cap is not falling apart, but the small cap door is already drafty. Cross-asset bonds are heavy, TLT down 0.42% at 82.41, IEF down 0.23% at 92.96. So rates are leaning tighter even without a clean 10-year quote on this screen. Dollars firmer at 28.125. The yen proxy is down 0.88%. And yeah, even if you only trade US stocks, keep an eye on that. Dollar strength plus weaker yen is the market's espresso shot, useful until everybody starts shaking. Then oil is the loud one, up 3.12% to 121.66 on the Iran uncertainty headline, while gold is softer at 397.65. That's not full panic. That's more like the inflation tax tapping the market on the shoulder right before the bell. Here's the open in one sentence. Softer jobs headline, higher oil, heavier bonds, flat mega cap, small caps lagging. Macro soup, no one ordered it, but here we are. The portal is flagging a US jobs report miss. I don't have the actual versus consensus table in this feed, so I'm treating it as growth sensitive until the bond market gives us the real vote. Existing home sales is also on today's high impact list, and housing is basically a lever bet on rates with a front door. On the equity side, the company desk's NVDA 223 line is still the AI mood ring into 930. If megacap tech can hold its bid while oil and the dollar stay firm, the index can look calmer than the macro underneath. The small cap runners the markets desk had, SCKT, JWEL, STKH. That's where the opening option can get messy fast. Volume persistence matters way more than the pre-market fireworks. Crypto is not exactly screaming risk on either. BITO down 0.34%, coin basically flat, MSTR down 0.45%. So here's what I'm watching into the bell. VIX around 20, IWM around 300, oil holding north of 121, and that NVDA 223 pivot. Bell's getting close. First print is about to tell us what was real and what was pre-market theater.
I've been digging into this market setup, and the cleanest way to frame it is this. We've got two forces pulling on equities at the same time. On one side, the Strait of Hormuz issue is putting a risk premium back into crude, and that immediately brings energy inflation back into the conversation. On the other side, the labor data has softened enough that Treasury yields have eased and the market is less worried about the Fed needing to press harder right away. That combination can create a rally, but it can also create a trap if the oil move starts feeding into inflation while growth is slowing. So the setup is not simply bullish or bearish, it is conditional. Starting with energy, Marathon Petroleum is a useful lens here, because the platform profile reminds us this is not a pure oil producer. MPC is mainly a downstream refining and marketing business, with midstream assets as well. That distinction matters. If crude rises because of a supply shock, producers can benefit directly from higher realized prices. But refiners are more about crack spreads, utilization, product demand, and inventory tightness. MPC is trading around $301 in the platform data, close to a $317 year high, with a market cap near $88 billion. So this is already a strong stock, not some undiscovered laggard suddenly waking up. The recent MPC news flow also lines up with the macro story. One of the recent headlines says Marathon delivered a massive earnings beat, helped by exceptional crack spreads and global refining disruptions, even though the stock later sold off. That is important, because it tells us the market may already be discounting strong refining conditions. Management commentary reportedly pointed to tight refining markets and elevated spreads potentially persisting. But that is exactly the kind of statement I would want to verify against inventory data, refinery outages, and demand indicators. Strong margins today do not automatically mean expanding multiples tomorrow if investors think we're near peak conditions. For the broader oil trade, I'm watching the levels more than the headlines alone. The research framework has Brent near the $85 area and WTI near the $80 area as key markers. Those levels matter because once oil starts grinding higher from geopolitical supply fears, it can bleed into gasoline, diesel, jet fuel, freight costs, and eventually inflation expectations. But the reason for the move matters. If oil is up because shipping is impaired, that is inflationary and potentially growth negative. If oil is up because demand is booming, equities can digest that more easily. Hormuz is obviously more in the supply risk bucket. That is where the pressure on consumer and travel names comes in. Higher fuel is not evenly distributed across the market. Cruise lines like Norwegian and Carnival are obvious examples, because fuel is a real operating cost, and discretionary travel is sensitive to household budgets. Airbnb is a little different because it is not directly buying fuel in the same way, but it still lives inside the travel wallet. If gasoline and airfares rise while job growth weakens, consumers may start trading down, shortening trips, or delaying travel. So the oil rally can look great for energy screens, while quietly tightening financial conditions for consumer-facing businesses. Now flip to the Fed side. The jobs report is the reason the market has been able to look through some of this oil concern so far. A reported loss of 23,000 jobs, plus downward revisions for May and June, changes the conversation. A softer labor market reduces the pressure for immediate additional rate hikes, because the Fed has to balance inflation against employment. That helps bring Treasury yields down, and lower yields usually support longer duration equities. But here's the catch. Weak jobs are not automatically good news. They are good for rate relief only if inflation cooperates. If inflation does not cooperate, that's where the stagflation word creeps back in. That yield relief is why technology, especially the semiconductor leadership, has been bid. NVIDIA and Broadcom are classic examples of names that can respond well when discount rates fall, because so much of the valuation argument is tied to future earnings power. But I would be careful about treating tech strength as proof that the whole market is healthy. Megacap tech can pull the index higher even while the average stock is doing very little. If NVIDIA, Broadcom, and a few other leaders are carrying the tape, that can work for a while, but it makes the rally more vulnerable to any CPI surprise or guidance wobble. The CPI report is the real hinge point. Expectations are for a slight cooling, around 3.4%, but that is still above the Fed's 2% target. A softer CPI would probably validate the market's rate relief trade. Lower yields, better support for growth stocks, and maybe more confidence that the Fed can stay patient. A hotter CPI, though, especially with oil moving up at the same time, would be a much more difficult mix. It would challenge the idea that the labor slowdown alone is enough to ease policy pressure. The market does not need perfect inflation, but it needs inflation moving in the right direction. Retail sales are the second part of the macro test, and honestly, they may be just as important as CPI for earnings. Inflation tells us about prices, but retail sales tell us whether consumers are still absorbing those prices. If retail sales hold up, the market can argue that households are slowing but not cracking. If retail sales disappoint while fuel costs rise, then investors have to start questioning second-half revenue assumptions. That matters for travel, consumer discretionary, restaurants, autos, even parts of housing-linked demand. The market has been willing to pay for earnings resilience, but it will be less forgiving if guidance starts reflecting a weaker consumer. On earnings, the headline number is strong. The research base points to Q2 earnings growth around 50%, and that kind of growth can absolutely support valuations, at least on the surface. But the market is forward-looking, so the debate shifts quickly from what companies just earned to what they can sustain. Were margins helped by temporary pricing power? Were energy and refining margins unusually strong? Are tech earnings broadening beyond the obvious AI infrastructure winners? Are consumer companies seeing traffic weaken? That is why I do not want to overstate the earnings cushion. Good Q2 numbers help, but second-half demand and guidance quality matter more from here. Breadth is the tell I keep coming back to. A healthy rally should not just be energy because oil is up and mega-cap tech because yields are down. You want to see banks, industrials, small caps, transports, and consumer names participate. Banks matter because they reflect credit and the economic cycle. Industrials matter because they speak to real economy demand. Small caps matter because they are more sensitive to domestic growth and financing conditions. If those groups join, the market is saying the slowdown is manageable. If they do not, then the index strength may be more fragile than it looks on the headline tape. There are a few verification points I would keep front and center. First, the Hormuz headlines need real-time checking. Negotiations, restricted passage, or alternative shipping route disruptions can change the oil setup fast. Second, watch Treasury yields and the dollar together. Lower yields help risk assets, but a stronger dollar can tighten global financial conditions and pressure multinational earnings. Third, for MPC and Valero, do not just assume higher crude equals higher profits. Check crack spreads, product inventories, refinery utilization, and any outage data. For Occidental, the crude price is more direct, but balance sheet and capital discipline still matter.
Thanks, company desk. Quick news brief from the macro desk. And first up, AI is moving from the chip story into the GDP story. ProTerminal's newsroom is tracking comments from BlackRock's chief investment strategist, Philippe Reeder, saying artificial intelligence could help sustain economic growth even as hiring slows. That matters because if output holds up while the labor market cools, the market gets a cleaner productivity narrative. Not just, more GPUs please, which at this point is basically Wall Street's version of ordering another espresso. The investor angle here is pretty straightforward. If AI actually shows up in productivity, it can support margins and GDP even with a softer jobs backdrop. But the keyword is actually. The tape is not blindly celebrating it this morning. QQQ is around 722.45, basically flat, while small caps are still softer with IWM near 300.27. So the macro desk translation is, AI can be the growth cushion, but it has to beat the rate, oil, and labor market headwinds on the scoreboard, not just in the slide deck. All right, cash market is open. Here at the macro desk, this is where the scoreboard stops being theoretical and starts charging rent. First print, SPY sitting around 772.8, basically flat, down 5 basis points. QQQ softer, 721.3, down about 0.25%. And that matters because NASDAQ has been the mood ring for the whole AI trade. Russell's at 301.1, down 15 basis points. So small caps are not exactly kicking the door open. And VIX is 20.10, actually red by about 1%, but still above that big round 20 line. So the open is mixed, not panicky. It's more like the market walked into the room, saw the oil price, saw rates, and said, yeah, I'm going to keep my coat on for a minute. Breadth is mixed, index gap is modest, but underneath the hood, we've already got violent single name action. And look at the first movers out of the gate. This is not a sleepy Monday. SCKT is still the circus tent, around 2.61, up roughly 576%, and that prior 2.50 reclaim from the markets desk just got hit at the open. STKH also hit that $4 pressure point, now around 4.28, up about 128%. JWEL is still green by about 161%, near 4.04. But remember, the earlier 4.50 downside callout already did its job, so that one's no longer a clean chase story. It's a battle over whether $4 becomes a floor or a trapdoor. On the downside, Scion is down 91% near 4.46. 10X down almost 88% near 1.67. So this is a split tape. Mega cap indices barely moving, small cap movers acting like somebody spilled espresso into the order book. For the broad market, I'm watching QQQ around 722 here. If that shelf gives way, that's where the NASDAQ softness starts to matter beyond just a red headline. Okay, macro chain real quick, because this is the part that explains why QQQ is acting a little heavy. Bonds are not helping. TLT's down about 0.5%. IEF's red too, so rates pressure is still sitting on the tape. Dollar's firm, yen is weak, gold is soft, and oil is the standout bid. That oil proxy is up about 3.3% around 121.87. So yeah, that's not exactly a clean risk-on cocktail. And then look at the crypto proxies. BITO, Coin, MSTR, all red. Not destroyed, but red. So the message is pretty simple. Mega cap growth isn't getting a free pass at the open. QQQ is basically testing that 722 area. VIX is still around 20. IWM is hanging just above 300. And if oil keeps holding north of 121, that becomes a real cross-asset input for the morning. Keyboard for me. QQQ 722 below, 723 above, VIX 20 as the stress line, IWM 300 as the small cap line in the sand, and oil 121 as the inflation pressure tell. I don't have the actual earnings name list in this feed right here, so I'm not going to make up tickers. But if you've got earnings on your calendar today, watch whether the market rewards beats or just sells strength. All right, that's the macro map. Let's get back to the single name tape and see where the real flow is hitting.
Thanks, Macro Desk. All right, Markets Desk is going straight to the movers board. Index tape is basically sleepy. SPY barely red, QQQ soft by a quarter point, IWM a little red, VIX still sitting right around 20. But this board, not sleepy at all. SCKT is still the monster, 261, up 576%, 60 million shares, relative volume over 2,000 times. JWEL and STKH right behind it, both already huge volume, both already danger zone momentum. Then flip the board and you've got SION down 91, 10X down almost 88. So this is the open right now. Squeeze tape up top, biotech wreckage underneath. We're going chart by chart. No wasted words. Levels, volume, tape. Okay. Pull SCKT first. Scoreboard update right away. That SCKT above 250 flag just hit at 934. Nice clean trigger. Now the hard part is whether it actually accepts up here. This is not normal tape. 500,000 float, about 60 million shares traded, 2,300 plus relative volume, and the stock sitting around 261 while the market is basically flat. That's pure small cap momentum. For me, the key is the failed reclaim risk. If this snaps back under 250 with real volume, that changes the character fast, because then the breakout crowd is suddenly underwater. If it keeps holding above that area, buyers are still defending the move. But yeah, don't marry this kind of chart. This is level only, volume only, and you respect the rug pull risk. Now JWEL. This was the one where we had the open below $4, and that matters because the stock is sitting around 375, up about 142%, but it's still underneath that big round number line. So I'm not chasing the green candle headline here. I'm watching the behavior into 4. If it stuffs up 4, that's your seller showing up exactly where they should. If it reclaims 4 and actually holds above it, different conversation. Volume is huge, 60 million shares, relative volume around 235 times, but dilution risk is marked high on this name, so the tape can be nasty. Nice mover, yes. Clean, only if it proves it around 4. STKH next, and scoreboard-wise that $4 level we flagged already hit, so now it's not about the first touch anymore. It's about acceptance. This is tiny float momentum. Float under 500,000, price around 415, up about 120%, 23.5 million shares traded. That's the exact recipe where it can squeeze hard, but also the exact recipe where a failed breakout traps late buyers instantly. So, above 4, I want to see buyers defending the level instead of just one wick through it. If it slips back under 4 and can't reclaim, that's the warning shot. In a sleepy index tape, this is where the action is, but this is also where you respect the trap risk. Flip it to CION now. This is the wreckage side of the board. 91% gap down biotech, trading around 443, and yeah, it's doing almost 9.4 million shares on about 20 times relative volume. But this is the exact kind of chart where the green candles can look exciting and still just be bounce attempts inside a disaster move. The market's basically sleepy today. SPY barely red, QQQ soft, so this isn't index pressure. This is name-specific damage. For me, the first clean line is 450. If SION can't reclaim that area and actually hold above it on the 1 minute, then the bounce is just noise. Underneath, you don't want to see those dips start accepting below 440 again, because then the dip buy crowd is getting tested fast. 10X is the second healthcare loser, and this one's nasty too, down almost 88%, sitting in the 160 area, 12.5 million shares traded, relative volume around 9 times. The context here is the failed study headline, so I really don't want to hype this like some clean bottom fishing setup. This is biotech event risk, doing biotech event risk things. On the 1 minute, the 160 zone is the spot I'm watching for whether buyers are actually defending anything, or whether it's just quick cover, quick fade action. If it starts living below 160, that tells you the bounce attempt is losing support. If it gets back above the mid-160s and holds there, okay, then at least the tape is stabilizing a little. But catching knives after a steady miss, man, that's where people get chopped up. AUUD next, and this is the headline-driven gainer I don't want to overcomplicate. We're not rehashing the whole filing story here. For the tape, the only question is continuation or fade. Stocks around 146, up about 78%, but look at the volume. Almost 85 million shares, 118 times relative volume. That's real eyeballs. Float's about 5.3 million, and dilution risk is flagged high. So yeah, it can move fast both ways. For me, the 1-minute check is simple. 150 is the reclaim area. If it can actually live above 150, okay, momentum traders keep paying attention. If it keeps rejecting there and starts losing 140, that's where this becomes a late buyer trap instead of a clean continuation. Quick lower board filter now. BWMN first, up 55% but only about 280,000 shares. Relative volume 1.8. So that's a big percentage move, sure, but it's not the same casino flow as SCKT or AUUD. ZJYL has the better trading pulse, 13.4 million shares, 12.5 times relative volume, small float around 2.8 million, so that one deserves more screen time if it keeps holding liquidity. VREX is different, bigger, cleaner, medical devices, around a 775 million market cap, up 48% on 3.8 times relative volume. Less squeezy, more real company move. And then XHLD, 7.7 million shares, 7 times relative volume, trading just under $3, but high dilution risk. So I'm treating that as a momentum tape only, not a name to get comfortable with. My ranking from here, AUUD and ZJYL for active flow, VREX for the cleaner follow-up, BWMN needs more volume. All right, movers board is set. We're flipping out of the squeeze tape and into the next live read.
Thanks, Markets Desk. Let's turn that mixtape into the company story on the AI chip group. The headline label this morning is Sanctions Rolling Further, but the names loaded here are NVDA, AVGO, MRVL, and AMD. So here at the company desk, the question is pretty simple. What does that actually change? QQQ's a little red, breadth is mixed, and NVDA is sitting right around that 223 marker we already had on the board. That's the first tell. Is policy risk just noise? Or does it start taxing the leadership names? Okay, now the key with NVIDIA is separating the business story from the headline risk. The recent company-side flow is still all AI infrastructure. Blackwell capacity, compute demand, networking, the whole stack. But sanctions, export controls, policy limits, that's a different kind of catalyst. It doesn't automatically mean demand disappears. It can mean timing risk, customer risk, geography risk, or just a lower multiple because investors don't want uncertainty sitting on top of a $5 trillion market cap name. And I'm being careful here. I don't have a fresh company-specific sanctions notice in this feed for NVIDIA, so I'm not going to pretend there's a direct hit. What we do have is NVDA slightly lagging QQQ this morning, price around 223, and a market that's asking whether the AI premium deserves a little policy risk haircut. Let's rotate to Broadcom, because AVGO is the cleaner confirmation read for me. NVIDIA is the obvious headline magnet. Broadcom tells you whether the market is still willing to pay for the plumbing underneath AI, custom silicon, networking, the infrastructure layer, without making this just one stock theater. If AVGO firms while NVDA hesitates, that says the market may be isolating the policy risk story to the biggest name. If AVGO starts leaking with it, then the desk has to respect that the whole AI infrastructure basket is getting repriced. Again, no fresh AVGO-specific sanctions item in the data here, so this is tape confirmation, not catalyst confirmation. Now, Marvell is a little different. MRVL tends to behave like a higher beta read on the same infrastructure spend. More sensitive when investors start questioning how broad the AI build-out really is. So if sanctions headlines are just background noise, you'd expect MRVL to eventually trade with the group. If it can't catch a bid while NVDA and Broadcom stabilize, that's your little warning that investors are narrowing the winners list again. That's the company desk angle, not AI good or AI bad. It's who keeps the benefit when policy risk enters the room. And then AMD. This is the competitive read. If the market is worried about one supplier, one geography, one policy channel, AMD can sometimes catch interest as the alternative AI accelerator story. But if AMD is heavy too, then the market's not playing substitution. It's just marking down semiconductor risk broadly. That matters with QQQ already a touch soft this morning. You don't need the index to be falling apart for relative weakness in semis to matter. The clean read here is whether AMD trades like a beneficiary of diversification, or just another chip name caught in the same policy discount. So bring it back to NVDA and keep the story tight. Sanctions rolling through are a risk premium, not automatically a broken business thesis. The line for the tape is still that existing 223 area on NVIDIA. Above it, the market is basically saying, fine, show me real damage before I re-rate this. Below it and heavy, especially if AVGO, MRVL, and AMD confirm, then the policy headline starts to matter more. Coming up, we've got the movers board again, and then a deal beat. But for this AI semi group, I'd keep the question simple. Is this headline changing orders or just changing the mood?
Thanks, Company Desk. Breaking macro hit. European shares are dipping after weak German industrial orders. ProTerminal's newsroom is tracking a worse-than-expected fall in German orders, and the early damage is landing in manufacturing-heavy parts of Europe. What we know, orders missed, equities reacted lower, and the market is reading that as a demand warning. What we don't know yet, whether this is a one-month wobble or the start of a wider slowdown. Germany is basically Europe's engine room, not a decorative hood ornament. So when that dashboard flashes amber, investors pay attention. Here at the macro desk, the read-through is cyclicals, exporters, and small caps. And with IWM still softer around 300.8, while SPY and QQQ are near flat, the US tape isn't panicking, but it's not exactly throwing confetti either. Next headline. U.S. Treasury yields are ticking higher ahead of upcoming inflation data. We don't have the full inflation print yet. That's the key thing. But the positioning is already showing up in duration. TLT is around 82.37, down about 0.5%, and IEF is down 0.25%, near 92.93. That's bonds getting leaned on. Why it matters? When yields firm, equity multiples have to earn their keep, especially anything priced like a long-duration growth asset. It's not an instant red alert moment, with QQQ only down a hair, but the discount rate hall monitor is back in the room, and nobody loves the hall monitor. And here's the counterweight. China's exports surprise to the upside. ProTerminal's newsroom is tracking stronger than expected export growth, which is important because it pushes back against the clean, easy story that global demand is just rolling over everywhere. Europe is flashing weakness, China is showing trade resilience, and US bonds are saying, yeah, don't get too comfortable. That's why the tape feels mixed instead of one way. 3 macro clocks on the wall, none of them set to the same time. For investors, the watch is whether this China export strength feeds into commodities and industrial sentiment, or whether Europe's manufacturing softness keeps capping the bid. Coming up, the M&A deal beat is on deck.
Thanks, Macro Desk. Let's hit the movers board, because the indexes are basically asleep and this board is not. SPY flat, QQQ flattish, IWM still a little heavy at 300.8, VIX just over 20. So when you see SCKT still up 438%, STKH up 234%, JWEL up 171%, that's not broad market strength, that's pure single name insanity. Look at the relative volume column. SCKT 2400 times normal. That is cartoon volume. STKH 328 times, JWEL 264 times. Then the other side is just brutal. SION down 91%, 10X down 88%. So here at the markets desk, I'm not treating this like a normal gainer list. This is a trap check board. Who's still bid, who's just bouncing, and who's already losing the opening drive. All right, SCKT first. And oof, this is the one where the headline number still looks huge, but the tape has gotten nastier. We're at about $2.08 now, still up 438%. But remember the setup. Tiny float, roughly 534,000 shares, and somehow 61.9 million shares have already traded. That's why this thing can rip, but it's also why the rug pulls are violent. I want to see whether buyers can actually defend $2. That's the line now. Above $2.20, you can at least say there's a little reclaim attempt starting. Below $2, this starts looking like another air pocket instead of a clean continuation. And with medium dilution risk on the profile, this is not a name to romanticize. Great trader tape, dangerous trader tape. STKH next. This is the cleaner squeeze check for me. Tiny float, about 500,000 shares, and it's already done 31 million shares. So yeah, the float has basically traded over and over and over again. Current price is sitting around $6.29, up 234%. So the headline is wild, but the question now is control. Is it holding that $6 area with higher lows, or are we starting to see those big upper wicks where every push gets sold into? If 6 stays firm and volume keeps coming in on green candles, fine. The tape is still organized. But if it starts slipping back under 6 and the bounces get weaker, that's where this can turn from squeeze into chase trap pretty fast. Now JWEL, and I'm not going to overcomplicate this one. It's still all about that $4 zone. We're at about $4.20, up 171%, and the volume is massive. 67 million shares, 264 times normal volume. So there are definitely buyers here. But this is also the name on the board with high dilution risk, so I don't treat every bounce like it's automatically clean. I want to see whether buyers are actually stabilizing above 4, meaning pullbacks get absorbed and the candles stop knifing. If 4 cracks and it can't reclaim quickly, that's a very different look. If it keeps basing over 4 with volume, then at least the tape is telling you demand is still showing up. SION now, totally different vibe. This is not a squeeze read. This is a gap down loser bounce check. You've got the stock around 437, down 91%, and still doing nearly 14 million shares. So there's liquidity, but the chart has to prove it can stop bleeding. For me, the repair zone is 450. That's the line. If it can't reclaim 450 and actually hold above it, every bounce is just suspect. Quick pop, sellers lean on it, lower high, back into the lows. So I'm watching the shape more than the headline percent. Does it build above the mid-430s, or does it keep wicking into 450 and failing? In a dead flat market, this kind of red biotech tape is its own universe. Don't confuse down a ton with cheap. TNX next. Same loser board, but this one's sitting right in that 150-160 battleground. Price is about $1.53, down 88%. 19 million shares traded. So again, plenty of eyes on it, but sellers have been in control. The big thing here is whether 150 is actually absorbing or whether it's just pausing before another leg lower. If it pops into 160 and immediately gets stuffed, that's your failed study wreckage tape. People try to bounce, supply shows up, and the low gets pressured again. So I'd frame it super simply. Above 160, maybe the bounce has room to breathe. Below 150, sellers are still pressing the lows. No hero mode on these broken biotech charts. You want confirmation, not just a red number that looks extreme. All right, quick deep dive on BCARU. This one jumped off the board, and oof, look at that candle. This is D-Boral Arc Acquisition Units, SPAC unit type structure, so don't treat it like a normal operating company tape. On the 1 minute, it based around that $4.80 to $5 zone, then volume finally woke up near 540, and it just ripped. Through 660, clean expansion, then straight into 820. Market's basically flat to soft, QQQ red, IWM red, and this thing's up triple digits. Here's the market's desk read. 820 is the day high lid right now. If it starts accepting above 820, that's the breakout confirmation level on the tape. But the real line I care about underneath is 660. That was the impulse breakout shelf. Lose 660, and this can go from momentum to trap very fast, because the move is already vertical. Volume did confirm it. We're talking a jump from tiny prints into thousands per minute. Last candle around that 8,000 share area. But that also means the chase is crowded. Thin SPAC units can reverse nasty. So yeah, momentum is real right now, but the risk is also real. Now catalyst check. I'm flipping over to the profile. I'm not seeing a fresh press release in the feed, so this looks more like tape-driven unit momentum than a clean new company headline. Filings show a 425 and an 8K from May, plus ownership filings, but nothing here that I'd call a fresh 9:57 a.m. reason for this exact spike. So for me, BKRU stays on the quick hit momentum list. Above 820 is where the squeeze tries to keep score. Below 660 is where the breakout starts looking suspect. Coming up, we'll hit the movers board again and see if this one holds the top of the tape.
Thanks. Markets Desk. Quick deal tape check here at the company desk. I'm going to slow this one down because this matters. The deal feed I've got right now is not showing a confirmed acquisition headline with terms. No buyer-seller pair, no cash price, no exchange ratio, no closing timeline. So we're not going to force an M&A story onto a green ticker just because it's moving. Okay, now put that next to the movers board. This is where traders get tripped up. A big gap can look like a deal premium, but a real M&A move usually has a very specific shape. Headline hits, price snaps toward the announced consideration, and then the spread tells you what the market thinks about completion risk. If it's cash, you're comparing the stock to the cash takeout price. If it's stock, now you care about the buyer's stock too. Without those terms, it's just tape, volume, and catalyst hunting. Interesting, sure, but not a merger arb setup. And the market backdrop makes that distinction even more important. SPY is basically flat. QQQ's a little red. IWM's a little red. VIX is just above 20. So if we had a clean cash takeout premium on the tape, it would probably stick out pretty clearly. That's not what I'm seeing from the data right now. The active names this morning are acting more like momentum, earnings, filings, microcap flow, that whole opening drive chaos, not a board-wide M&A tape.
Thanks, company desk. Let's zoom out to the macro tape for a second. The headline level here is simple. SPY is basically flat at 773.53. QQQ is just red at 722.55, and the Russell is the weak kid at the lunch table. IWM down about 0.3 at 300.63. VIX is lower, 20.06, down 1.28%, but 20 is still not exactly beach chair volatility. So the market's calmish, not carefree. The reason is that we've got this softer jobs backdrop in the news, which is taking some pressure off the rate hike fear trade. But then oil comes barging through the door, up 4.46% to 123.245. That's the fly in the punch bowl. Softer labor says, hey, maybe conditions are cooling. Oil says, cool story, your input costs just got louder. That's why the index level looks sleepy, but the macro undercarriage is moving.
All right, top of the hour. It's 10:01 here at the macro desk.
Quick market minute reset if you're just joining us. The tape is basically doing that Monday morning shoulder shrug thing. SPY 773.5, up just 0.03%. QQQ 722.3, down 0.10%. Russell softer at 300.9, down 0.22%, and the VIX is sitting right on that 20 line, off 1.3%. So equities are not panicking, but they're not exactly throwing a parade either. The story underneath is tighter financial conditions with a side of energy pressure. Long bonds are red, TLT down 0.6%, IEF down 0.32%. The dollar is firmer at 28.145, up 0.27%, and the yen is getting hit, down 0.91% to 57.71. Even if you only trade U.S. stocks, keep one eye on that yen-dollar pressure, because when FX starts waving its arms, risk assets usually at least look over their shoulder. The cross-asset chain is pretty clean this morning. Bonds lower means yields are leaning higher, the dollar catches a bid, gold loses a little safe haven shine. GLD 396.23, down 0.56%. And crypto is acting like it noticed the tighter liquidity vibe first. BITO down 0.89%. Coin down 2.49%. MSTR down 2.67%. But the oddball, and honestly the loudest thing on the macro board, is oil. USO 123.70, up 4.85%. That's the market's inflation thermostat getting turned back up, which is why the index tape can look flat while the internals feel a little cranky. Levels I'm watching: VIX holding around 20, QQQ's intraday floor near 720.75 and top near 723.25, and whether oil can stay bid above 123.70. Also on today's radar, existing home sales, plus earnings names like DEO, IHG, and Fubo. Coming up, we go right back to the market mover scan, then a quick pro terminal look under the hood.
Thanks, Macro Desk. All right, Markets Desk is grabbing the movers board. And yeah, this board is loud again. SPY basically flat, QQQ slightly red, IWM red, VIX still hanging around 20, but look at these small cap names. SCKT still top of the board, up 324%. BCARU up 188, STKH up 172, JWEL still over a double, but here's the thing. We've already had a few downside flags hit in the last few minutes. SCKT lost that earlier $2 area, STKH cracked, 10x cracked, so I'm not treating green as automatically clean. This is trader tape. Fast, emotional, and wick heavy. Let's go straight to SCKT on the 1 minute, because this is the scorekeeper right now. Price is around $1.64, still up massive on the day, but oof, this is not the same look as a clean opening squeeze. You've got only about a 500,000 share float listed, and over 64 million shares have already gone through it. That's churn. That's not casual volume. The question from here is simple. Does the bid keep defending around 160? Or does this turn into the second leg of the unwind after losing $2? If it starts accepting back over 175, okay, buyers are at least trying to repair it. But under 160, I'm reading that as more trap risk, not fresh momentum. Medium dilution risk on the board too, so no hero worship here. This is a trading vehicle, not a victory lap.
Thanks, Markets Desk. Let's bring it over to the Stock Whisperer and manage the paper book. This is the show's simulated portfolio, so I'm not asking anybody to copy anything here. I'm just walking through thesis, level, and defined risk. Indexes are basically drifting near highs. Breadth is mixed, VIX is lower, so the message for me is pretty simple. Don't chase the hottest stuff on the board. Let the winners work, tighten the brackets, and only add exposure if the tape earns it. Okay, positions first. CVX is the clean one on the long side. 45 shares from 186.95, trading around 192.10, open gain about $231, 2.75%. That one's getting help from the oil rebound, so I want to protect it without choking it. INTC is a small open short, 100 shares from 97.30, basically flat to green by about $10. No victory lap there. It's still just a dilution risk thesis that needs follow-through. And 10x, that's the big paper winner right now. Short 1,200 shares from 186, price around 150, open gain about 433, roughly 19%. That's exactly where I don't want to get sloppy. Let's deal with 10x first. The short is working, but it's hovering near that prior protection zone, so I'm not giving it a full leash anymore. Original idea was negative catalyst, weak tape in the name, and a flush toward 130 if sellers kept leaning on it. The adjustment now, buy stop comes down to 153. That protects most of the open gain if it snaps back. The take profit stays down at 130 because if this thing loses the bid again, I still want the paper account to have a defined exit waiting. Low-priced biotech shorts can rip your face off on one headline, so the bracket matters more than the opinion. All right, updating 10x now. I'm selecting the position, setting the protective buy stop at 153, leaving the downside cover target at 130, and submitting that bracket update. There it is. So for the paper book, 10x is no longer an open-ended winner. If it rebounds through 153, we protect the trade. If sellers press it into 130, the target is already resting. That's the whole job. Remove the emotion before the next candle decides. Now CVX. This one's a different personality completely. It's a large cap energy long, and with crude staying bid, the thesis is still intact. But I'm not treating green P&L like it's guaranteed. Entry is 186.95. Current is around 192.10, so the paper trade has room to breathe. I'm raising the stop to 188.75, above break-even, and leaving the profit target at 195.50. That means if the oil bounce fades, the paper account should still keep a win. If energy keeps leading, we give CVX space to keep working toward the target. Let's make that CVX adjustment on screen. Selecting CVX, stop goes 188.75, target stays 195.50, submitting the protection. Done. And quick note on INTC while we're here. I'm not changing that bracket right now. The position is basically flat. The short thesis is still tied to that potential $15 billion stock sale dilution overhang. But I want actual downside follow-through. For me, 95.50 is still the level where the short starts to prove itself. Until then, it's just a controlled paper position, not a victory. So, the Stock Whisperer book is tighter now. 10x short protected, CVX long protected, INTC left alone until it proves lower. Watchlist stays selective. AAPL above 307.50 only if QQQ firms with it. NVDA above 224.25 if tech actually turns green. And INTC below 95.50 for short follow-through. I'm not forcing a fresh trade into mixed prep at 10 or 5 in the morning. Coming up, we'll flip into the ProTerminal promo and show you the tools behind the screens we've been using all morning.
Thanks, Stock Whisperer. Breaking macro wire first. ProTerminal's newsroom is tracking Powell, signaling no rate cuts are likely until late 2026. What happened? The Fed chair is still leaning hard on inflation being above target, even though it has cooled. What we know, the message is higher for longer, not cuts around the corner. What we don't know yet, whether the broader Fed lineup leans the same way after the next inflation data. And we don't have a fresh voting map in this headline. Market read, bonds don't love it. TLT down 0.6, IEF down about 1/3. And the dollar is bid, with UUP just tagging that 28.14 level the macro desk flagged earlier. Equities are doing the board cat act. SPY around 773.8, QQQ around 723.4, basically flat. IWM red by about 1/3. That's the tell. Mega cap tape can absorb a lot, but higher financing costs hit small caps, credit, and long duration growth first. VIX near 20. So this is not panic. It's a repricing memo, written in Fed font, which is somehow always 12 pages longer than necessary. Next headline, oil prices surge on Middle East tensions. The desk is seeing crude pushed higher by geopolitical unrest in the region, and the market problem is simple. Oil is not just a commodity chart, it's a tax with a ticker. Our oil proxy is sitting around 123.70, up 4.85%, and that's the loud macro print this morning. Why it matters. Higher energy costs can squeeze margins for transports, retailers, manufacturers, and they hit consumers at the pump. Energy equities can catch rotation, sure, but for the broad tape, this complicates the clean disinflation story. Put that next to Powell saying cuts are unlikely until late 2026, and you've got the market trying to price slower relief on rates while input costs jump. Third headline, U.S. consumer confidence unexpectedly drops. ProTerminal's macro desk is seeing sentiment fall sharply this month, even with the jobs market still described as strong. That's the part that matters. Jobs can look solid on the surface, but if households start pulling back, consumer discretionary gets the first cold breeze. With consumer spending such a big part of the economy, this headline speaks to growth risk, not just vibes. Tie it back to the first two stories, and the picture is pretty clean. Rates staying higher, oil squeezing budgets, confidence rolling over. That's why the small cap line matters today. IWM around 300.5 and down about 1/3%, while the big indexes sit flat. All right, coming up, we'll flip back to the market mover scan and see who's ignoring the macro memo.
Thanks, Macro Desk. Quick pit stop on the actual kit we're using here at the Markets Desk. This board right here is ProTerminal's Market Movers. Not a magic buy button, it's the scanner. It tells us what's actually moving, what's got relative volume, what's up, what's smoked, Where the action is. SCKT sitting near the top today. Huge move, monster relative volume, and that's exactly why we start here before we ever get cute with a chart. Now the part traders skip when they're too excited. Dilution. Oof, this matters, especially on small caps. ProTerminal has the dilution center so you can check shelves, ATMs, offerings, warrant overhang, all the stuff that can hit a runner right when the chart looks clean. Again, it doesn't tell you what to do. It gives you the risk map. And in this tape, with IWM red, while QQQ and SPY are barely green, you do not want to be blind to financing risk. Then, for a single name, we go into the profile. Same ticker, SCKT, filings first. Recent SEC filings are where the real texture lives. Offerings, registrations, material updates, all that. Then, flip the tab. Check insider activity. If there's buying, selling, no recent activity, whatever the page shows, you want that context before you start making up stories from a 1-minute candle. This is research flow. And then, boom, back to the 1-minute terminal chart, because the tape still has to confirm. This is where we read volume, wicks, VWAP behavior, where the bids show up, where the offers lean on it. Look, data can be incomplete or delayed sometimes, and this stream is educational. You're still making your own decisions. But if you want the same movers, charts, dilution checks, filings, insider tabs, all in one workflow, that's ProTerminal. Sign up at proterminal.io. All right, coming up, back to the market movers scan.
All right, Markets Desk is back on the movers board. Let's hit the tape fast. SPY barely green, QQQ up a hair, IWM still red, VIX sitting around 20, so this is not some broad risk-on party. These top names are their own thing. SCKT is still the monster, up basically 400%, 67 million shares, relative volume over 2,600 times, and the float listed around 534,000. Same turnover. STKH right behind it, up almost 200%, 41 million shares. Tiny float there too. BCARU's the SPAC unit oddball, and look, that prior 850 area just got clipped, so we need to recheck that chart, not just admire the percentage gain. JWEL is up 134 with high dilution risk on the board. Then the pain side. SION down 90 plus. TENX down almost 89. Oof. Winners are loud, losers are brutal. This is a trader's board, not a sleepy Monday board. Let's pull SCKT first, because yeah, that reclaim we flagged earlier got hit. Scoreboard item. But I don't want to recycle the same read. Fresh chart now. Price is around $1.93, still up roughly 400%, and the volume is just absurd for a 500,000 float name. So here's the Markets Desk read. $2 is the clean upside line now. Not magic, just psychology plus liquidity. If SCKT starts accepting above 2 and the 1-minute candle stops snapping back under it, that tells you the bid is still engaged. But if every poke into 2 gets wicked, oof, look at that kind of action when it happens. That's not clean continuation, that's churn. On the downside, I'd watch 180 as the tone change spot. Lose that after a move this stretched, and the late longs can get very uncomfortable, very fast. Medium dilution risk is on the board too, so with these microcap rockets, the chart has to confirm. The headline percentage alone is not the trade. STKH is the next one, and this is exactly why I keep saying these tiny float names are a different sport. You've got Stakeholder Foods up about 196%. 41 million shares traded. Relative volume over 400 times normal. And the float on the board is under 500,000. So yeah, when it squeezes, it really squeezes. On the 1 minute, the whole question for me is whether $5 keeps acting like the line in the sand. Above 5, buyers are still defending the breakout zone, and you can see the squeeze is at least trying to stay alive. But if this starts printing big upper wicks and then loses 5, that's where the exhaustion risk gets real fast. I'm not chasing that type of move blind. I'm watching whether dips hold cleanly or if every pop just gets sold into. Now, BCARU, and yep, scoreboard update here. That below 850 level we talked about got hit. This is a SPAC unit, so I'm treating this way differently than a normal operating company momentum name. It's still green huge on the board, up about 177%, but volume is only around 72,000 shares, even though that's massive versus its usual tape. The issue now is acceptance. If 850 was the shelf and it can't reclaim it, then the move starts looking a little air-pockety instead of strong continuation. I'd want to see buyers actually take it back above 850 and hold there. Otherwise, this can just drift, because with SPAC units the liquidity can get weird, and those moves can lose speed without much warning. JWEL next, and this one is loud, but it's also not clean. Jowl Global up about 134%, trading around 363, and the volume is huge, 71 million shares, about 279 times normal. So yeah, there's real attention here, but here's the trap check. High dilution risk, tiny market cap, roughly 2 million share float, and when these get this much volume, the question is not just, did it run? It's, are the volume bursts still lifting price, or are they just giving sellers liquidity? On the 1 minute, I'm watching that 350 area as the quick line. If 350 keeps holding, and the next burst actually pushes through the prior pop, fine, momentum is still alive. If it loses 350 and every bounce starts stalling under the last candle high, that's where this turns from runner into fade machine pretty fast. Now flip it, SION on the loser board. This is the other side of the same small cap tape. Siona down about 92%, sitting near 420, with 16.8 million shares traded and 36 times normal volume. That's not a normal red day, that's a full gap down reset. On the 1 minute, I'm not trying to call a bottom on something like this. I'm checking the bounce attempts. Do they reclaim prior breakdown candles, or do they pop for 2 minutes and immediately print a lower high? $4 is the obvious psychological spot below, and then the upside test is that 450 zone. If it can't start holding above those little lower high shelves, the tape is still telling you sellers are in control, even if you get sharp biotech-style snapback candles.
Thanks, Markets Desk. Quick stock whisperer check-in on the paper book. Alright, you can see the new line item here. MSFT, 25 shares long, average just over 510.18. Current print, basically flat at 510.22. So this is not a victory lap. It's a fresh setup. The thesis is simple. Microsoft has that new Maya 300 AI chip headline. QQQ is green, not screaming but green, and MSFT is holding firm with the tape. So here at the Stock Whisperer, I took the defined risk long for continuation in the simulated portfolio. The bracket is the whole trade. Risk is down at 502.40. Upside target is 526.80. And the confirmation level I'm watching now is 515. If it can't get through 515, I don't need to pretend the headline is doing more than it is. Now, quick grade on the rest of the simulated book. CVX is still the clean one. Long 45 shares from 186.96, now 192.10, up about $231 on the position. And the bracket has the stop at 189.40, with the 195.50 target still working. TENX is still the big paper winner on the short side. Short from 186, trading 150, up $432 unrealized, with the cover target at 1.30 and the protective stop now 1.58. INTC is the problem child, short from 97.31, trading 97.58, down about $27, so nothing dramatic, but it hasn't paid us yet. I'm still watching 95.50 for downside follow-through there. And just to be crystal clear, this is the show's simulated paper trading portfolio. We're showing thesis, levels, and risk management, not telling anybody to copy trades.
Thanks, Stock Whisperer. Markets Desk is pulling up YJ, because this one is ugly on the tape. SPY and QQQ are slightly green, breadth is mixed, and YJ is down about 34%. That's relative weakness, big time. Small China e-commerce name, roughly 11 million market cap, around 4.9 million shares out. And the volume is the story right away. Average volume around 5,300, today already pushing 874,000. So this is not normal flow. This is a real sell volume event. Okay, look at the 1 minute. Oof. Look at that failure up top. Open was around 253. It tried to live above 250, couldn't do it, and then the trapdoor opened. You get that sharp dump from the 250s into the 240s on the volume spike. Then every bounce after that is lighter. That's the key. Sellers hit it with size. Buyers are just nibbling on the bounce. Structure is lower highs, lower lows all morning. Right now the chart's trying to base under 240, but it hasn't reclaimed anything important yet. For the scoreboard, 223 is the support line I'm watching below. If that cracks, the low-end pressure is still active. 240 is the first reclaim test, and 250 is the real resistance shelf from the failed open. Now, quick catalyst check, because with these small cap moves, I want to know if there's an actual headline or if it's just liquidity getting run over. On the company news feed, I'm not seeing a same-day press release explaining this morning's drop. The latest items here are the April 24th 20F annual report filing and the March 27th second half and fiscal year results. So for right now, the live read is price and volume first. No fresh company headline in this feed that neatly explains a 30+% move. One more thing here, and this matters on a tiny name like YJ. Dilution context. The dilution center has overall risk at medium, no active shelf showing, but an active equity line is flagged. Amount raised over the last 12 months shows 0. Runway is listed around 22.8 months. So I'm not calling an instant offering headline. We don't have that. But overhead supply risk is part of the tape on small caps, especially when the bounce volume is weak. Back to the chart. Markets desk scorecard is simple. Below 223, sellers still have it. Above 240 starts a bounce attempt. Above 250 is where the failed open area gets tested. Until then, this is a broken chart trying to stop bleeding, not a clean reversal. Alright, let's hit the movers board. Markets desk is going straight to what's actually moving. SPY and QQQ are barely green. IWM is still red. VIX is lower, so this is not some giant broad risk-on party. This is very specific small cap heat. Top of the board, SCKT still leading, STKH right behind it, then JWEL and BCARU. On the ugly side, SION and 10X are still the damage names. Oof, look at the separation here. Triple-digit green on the runners, while small caps broadly are soft. So I care less about the headline percent now and more about the next candle. Does volume keep paying the high, or does the first lower high turn into a rug? We're going one by one. Okay, SCKT on the 1 minute. This is the kind of chart where you keep score in pennies, not vibes. Board mark is around 191, still up just under 400%, and the volume is wild, about 69.4 million shares traded. Earlier, that 175 level we flagged already got paid. Nice score. Now the live pivot for me is 190. If it starts living below 190 and VWAP can't firm it up, I'm not calling that strength. That's chop after a monster squeeze. If buyers keep defending above it, then the move is still being supported. But tiny float mechanics are nasty. One wick, one air pocket, and boom, totally different tape. Don't marry it. Watch the candles. Watch the bid. STKH now. And yeah, this one's still hanging in that $6 area. Board mark 613, up about 226%. Tiny float, right? Roughly 500,000 shares, and it's already done 50 million shares of volume. So this is pure momentum mechanics. What I'm watching on the 1 minute is whether this keeps accepting above 6, or whether every push starts printing lower highs and the crowd just loses interest. That's the difference here. If it's reclaiming 6 with volume behind it, okay, continuation is still alive. If it keeps wicking through 6 and snapping back under, that's usually where these tiny float names turn from runner to chop machine really fast. Now, JWEL. This is the other big volume monster on the board. 373-ish, up 140%. And look at the turnover. 72 million shares versus a normal day around 250,000. That's not a normal tape. That's a full crowd event. The float is bigger than STKH, about 2 million shares, but it's still small enough that candles can get nasty. So I'm not chasing the headline percent here. I'm checking if buyers are actually holding the upper range. For me, 350 is the clean gut check zone on this one. Hold above there, and the chart stays constructive. Lose it with speed, and it can turn into that rinse-out fade. Also, dilution risk is marked high on JWEL, so just keep that in the background while reading the chart. BCARU now, and this is where I don't want anybody getting starry-eyed just because the percent column is huge. This is a SPAC unit. Board mark about 733, up roughly 140%, but the actual volume is only about 90,000 shares. Relative volume looks wild because the average volume is tiny, under 1,000. So yeah, it's moving, but this is a liquidity story first. And that earlier 850 area, once it couldn't hold below there, that was your warning that the bid was getting thin. Now the question is acceptance. Can it actually build above 750, or is this just random prints in a thin name? I care way more about that than one green candle. Quick loser board check, because these are nasty moves, and the bounces can look way cleaner than they actually are. SION's around 414, still down basically 92%, with 17 plus million shares traded. The level we cared about was 450. If it can't reclaim 450 and stay there, I'm treating the bounce as dead cat chop, not a real trend change, just shorts covering and dip buyers fighting the tape. Now 10x, same idea, different price zone. This one's around 153, down almost 89%, volume close to 27 million. The 150 line matters because it's right where the tape is trying to stabilize. Above 150 and building is at least something to monitor. If it keeps slicing through 150 both ways, that's not clean momentum. AUUD versus LZMH is the mid-board rotation I care about next. AUUD is only up about 59%, which sounds funny after SCKT and STKH. But look at the turnover. Basically 99 million shares, 131 on the board, relative volume around 139 times, and it's got that high dilution risk tag. So yeah, it's active, it's liquid, but this is not a clean, oh cool, cheap software name situation. This is a high-risk tape where the volume is the story. Now flip that against LZMH. 197, up about 64%, but only about 1.2 million shares and relative volume under 4. Bigger float too, around 39 million. So LZMH is green, but AUUD is the one actually chewing through shares like a real intraday battleground. Quick cleanup. ZJYL, 340-ish, up 58%, 15 million shares, and that recent filing flag matters. When a small healthcare instrument name is moving like this, I want the filings checked, not ignored. And XHLD, 326, up 61%, 24 million shares, 2.3 million float, high dilution risk. Active enough to stay on the scan, but same rule, don't fall in love with the percent column. So my next watch list from this board is AUUD for raw turnover, XHLD for active follow-through, ZJYL for the filing angle, and LZMH only if volume actually wakes up. All right, that's the microcap heat check. Let's keep the alerts on and pivot to the next setup.
Thanks, Markets Desk. Breaking macro wire here. The U.S. unexpectedly shed 23,000 jobs in July, the first net jobs loss in years. And that is the headline the macro desk is leading with right now. What happened? Payrolls went negative, not just slower, actually negative, which points to a softening labor market. What we don't know yet is whether this is one weird month or the start of a real trend. This card does not give us enough to make that leap, so we're not doing the victory lap or the panic lap. Market read is messy, which is usually how macro likes to enter the room and spill coffee on everyone. SPY is around 774.3, up 0.13%. QQQ 723.6, up 0.09%. But IWM is down 0.22% at 300.9, so small caps are not exactly throwing a party. VIX is 20.12, a little lower, while TLT is down 0.59% at 82.27, and the dollar is firmer at 28.14. Translation: softer jobs, yes, but not a clean recession bid tape yet. Next headline. Wage gains from the biggest increase in 40 years are being completely eaten up by inflation. So yes, nominal pay moved higher, but the purchasing power math is the problem. The paycheck got a raise and the grocery receipt got a bigger promotion. Why it matters for markets. If real incomes are flat, consumer spending gets more fragile, and that flows straight into revenue assumptions for anything tied to discretionary demand. And look at the cross-asset backdrop while we say that. Oil is up 4.87% at 123.72, which keeps input cost pressure right in the frame, while gold is down 0.45% at 396.68. That's not a simple inflation is gone setup. It's a consumer squeeze story, and for equities that means margins and guidance start mattering a lot more than vibes. Third headline. Despite the weak jobs report, the Fed has not ruled out another interest rate increase. That's the uncomfortable part. We flagged this earlier here at the macro desk. The labor side is softening, but inflation pressure is still hanging around, so policy is not giving the market a clean green light. Why investors care? Yields, the dollar, megacap multiples, crypto beta, all of that stays sensitive when the Fed door is still cracked open. You can see the split. QQQ is green, but barely. IWM is red. BITO is down 0.74%. Coin is down 2.71%, and MSTR is down 2.51%. That's not a broad risk-on stampede. That's the market trying to decide whether bad labor news is good rate news or just, bad news. Coming up, we'll kick it back toward the movers board and see which single names are ignoring the macro weather report.
Thanks, Macro Desk. All right, quick stock whisperer check-in on the simulated paper portfolio. This is the broadcast paper account, not a copy this book. And right now the open book is net green by about $658. CVX is still the steady one, long 45 shares from 186.955, last around 192.10, up about $231, and that oil tailwind thesis still holds while it stays firm above the raise stop. MSFT is the fresh long, 25 shares from 510.18, now 512.945, up about $69. So it's working, but it's not a victory lap yet. INTC is the uncomfortable one, short 100 from 97.3065, now 97.93, down about $62. So the dilution thesis is still there, but price has not rewarded it yet, and TENX is still the biggest open contributor, short 1,200 from 1.86, now about 1.51, up roughly $420. Calm book, defined risk, no new button mashing just because the macro tape got loud. Now, the brackets, this is where the stock whisperer keeps the ego out of it. CVX has the take profit sitting at 195.50 and the protective stop at 189.40. So that trade has room, but if it rolls back through that stop, the paper book respects it. MSFT has its take profit up at 526.80 and the stop down at 502.40. The cleaner confirmation level for me is still 515. If it can hold above there with QQQ green, that says the Maya chip headline is getting real follow-through. INTC is bracketed with the cover target at 92.25 and the stop at 125. I don't love that it's red against us, but it's small, and the trade is still inside the defined range. The level that matters is 95.50 below. If sellers press it through there, then the short starts acting more like the thesis. TENX is bracketed with the cover target at 130 and the protective stop at 158. That one already got protected earlier, so I'm not tightening again just because it's close to the line. Let the plan work, or let the stop work. What I'm watching from here, AAPL only gets my attention above 307.50, and only if QQQ stays firm. I'm not ignoring that downgrade noise. MSFT above 515 is the clean follow-through check for the long we already have. INTC below 95.50 is the follow-through check for the short. Tape's mixed. SPY and QQQ slightly green. IWM still red, so I'm fine being patient here. No new simulated trades in this update. Coming up, the markets desk has the movers board, and we'll see if any of those microcap levels actually held up.
Thanks, Stock Whisperer. Alright, markets desk is back on the movers board, and this board is absolutely not normal. SPY and QQQ are barely green. IWM is red, breadth is mixed, and meanwhile SCKT is up 430%. That's not market beta, that's pure event tape. Top of the board, SCKT, BCARU, STKH, JWEL, all massive relative volume prints. Then the ugly side has SION down 91, 10X down 88. So this is a split tape. Squeezes on one side, biotech air pockets on the other. We're not marrying any of these. We're reading levels, volume, and where the bid actually holds. First chart is SCKT, and yeah, scoreboard name. I'm not rerunning the whole intro, but look at the numbers. 205 last, up about 430%, 76 million shares. Relative volume basically off the screen at 2,900 times average. Float's tiny, about 534,000, so every candle can get stupid fast. The earlier 175 callout hit, clean. Now the market's testing whether this can stay a $2 stock or if it rolls back into that existing 190 pivot. For me, $2 is the live warning shelf. If that cracks, oof, the squeeze tone cools fast. If it keeps holding above 2 with volume still printing, shorts are still fighting a really thin float. Medium dilution risk is in the background here too, so don't get cute and pretend this is clean institutional accumulation. This is hot tape, not a comfort trade. Now, BCARU, totally different animal than SCKT. This is a SPAC unit, sitting basically right at $10. Last print 999.9, up 228%, but only about 136,000 shares traded. So yeah, relative volume looks wild because the average volume is basically nothing, under 1,000 shares, but that also means you've got to be really careful reading the 1-minute candles here. If this chart is printing in chunks, wide spreads, little air pockets, that's not the same as clean momentum. For me, the whole read is the $10 area. If buyers can actually keep accepting above 10 with real prints, okay, that's at least cleaner. But if every bounce into 10 is just one print and then it disappears, that's spread noise, not a real tape. STKH next. And this one's much more tradable looking just from activity. 55 million shares, 575 times relative volume, float shown under 500,000. That's the squeeze recipe, but it also means the rug pull risk is real. We flagged the $6 acceptance idea earlier, and right now with this thing around 520, that level matters because it separates a real continuation attempt from just a lower high fade. If STKH can reclaim 6 and hold it for more than a quick wick, then the chart starts repairing. If 6 keeps rejecting and the 1-minute highs keep stepping down, that's the market telling you the squeeze is cooling off. I'm also watching whether dips are getting bought quickly or whether volume is only showing up on red candles. That's the tell. Strong runners absorb pullbacks. Tired runners bounce once, fail under the prior high, and then VWAP starts acting like a ceiling. JWEL is next, and this is the retail one. Jowl Global, specialty retail out of China. Last print around 327, up 111%. And look, the volume is real. 73 million shares, about 286 times normal volume. So this is not some sleepy gap that nobody touched. But the gut check for me is still 350. If this thing can't get back above 350 and actually stay there, then it's just a huge volume churn name under a very obvious level. Also, high dilution risk tagged on the board, so I'm not going to overdo the story here. The tape is hot, the volume is hot, but that backdrop matters. 350 is the line I'd want respected, before calling it anything cleaner than momentum rotation. Now, flip the board for a second, because the loser side is nasty. SION first. This is biotech damage, not a normal fade. 419, down basically 92%. 18 million shares traded, almost 40 times relative volume. For SION, 450 is the first clean reclaim level. If it's living under 450, the bounce is still suspect. That's not strength. That's just people trying to catch a falling piano. Now 10X is the same sector, but a different structure. 149 last, down about 89%, and it's actually done more shares, almost 30 million, but relative volume is lower than SION at about 22 times. 150 is the battle line there. Above 150, at least it's trying to stabilize. Below 150, you've got that psychological break where trapped longs can keep hitting bids. Biotech loser board bounces can be violent, but the first question is always quality of rebound, not just how red the percentage looks. Alright, quick cleanup on the lower board momentum names before we move on. AUUD first. Audio and podcast software name, last around 141, up 71%, and this is the most active name on the board by raw volume, 104 million shares. That's real churn. But, and this matters, the board has high dilution risk flagged here, so I'm not treating that like clean sponsorship. For me, the tell is super simple. After that much volume, does 140 keep acting like a defended area, or does it start slipping and become just a liquidity event? Now, XHLD, 10 holdings, broadcasting and event production, 330, up 63%, 26 million shares, about 24 times relative volume. Also high dilution risk on the board, smaller float, so same deal. If buyers are really in control, 330 can't just vanish on the first pullback. ZJYL next, medical instruments, wheelchair and living aids products. This one has the recent filing flag. 340, up 58%, 15.7 million shares. Nice relative strength, but I'd keep it tied to that 340 zone and the filing context. And then BWMN is the cleaner industrials gapper in the set. Bowman Consulting, 4236, up 55%, 1.6 million shares, 10 times relative volume, much bigger market cap, bigger float, engineering and construction. Totally different profile than the tiny high dilution runners. So that's the board. Indexes barely green, SPY and QQQ basically flat, and we've got these monster single name dislocations. All right, movers board is cleaned up. Let's hand it forward to the next setup.
All right, quick pit stop. This is the toolkit the markets desk is using while the tape is moving. First stop, dilution center. This is where I want small cap traders looking before they fall in love with a runner. Shelves, ATMs, offerings, warrants, all the stuff that can hit a chart when the headline looks clean but the cap table is messy. Not a buy or sell signal. It's context. Risk first, then chart. Now back to the movers board. This is the heartbeat of the morning. SPY's barely green. QQQ's barely green. IWM's red. Breadth mixed. So when something like SCKT is up 400+% on monster relative volume, that sticks out fast. But key point, movers are a research starting line, not a green light. I want price, volume, float, market cap, sector, all of it in one place, so I can decide what deserves a chart and what's just noise. And this is the part people skip. Filings. Oof, don't skip filings. If we're looking at a hot name, I want the recent SEC stuff right there. Offerings, shelf registrations, 8Ks, prospectus supplements, whatever changed. Then I'll flick to insider trades and news if the name has them. Sometimes the cleanest trade filter is just, wait, why is this thing able to issue stock? Data can be incomplete or delayed like any live platform. So you still read the source documents, but having it organized fast is huge. Last piece, the 1-minute terminal chart. This is where we keep score. Where did volume come in? Where did the wick reject? Where's VWAP? Where are buyers actually defending? Look at the tool stack. Movers, dilution, filings, insider trades, news, charts. That's the workflow. Educational stream, self-directed research, no magic button. But if you want the same screens we're using here at the markets desk, go to proterminal.io. Coming up next, we're right back to the movers board.
All right, markets desk is back on the movers board. Promo's over, now we put the tool to work. Look at this board. SPY's up a little, QQQ's barely green, IWM's red, VIX is softer, breadth is mixed, and then this board is just chaos. SCKT still top of the stack, up 400%. BCARU still hanging around that $10 area. STKH still triple digits. JWEL still holding a monster gap. So yeah, this is not the index doing the lifting. This is pure small cap tape. On the red side, SION and 10X are still wrecked, and those are different beasts. Biotech headline damage, not just morning profit taking. Here at the markets desk, I'm sorting this into 3 buckets. Real volume momentum, weird unit SPAC liquidity, and loser board bounce traps. We start with SCKT, then we're going 1-minute chart, one name at a time. Okay, SCKT first. Oof, this is the scoreboard monster, but now the whole question is whether $2 is resistance instead of support. Price is around $1.95, still up roughly 405%, with almost 79 million shares traded. Against a normal day, that's tiny. Relative volume over 3,000 times, that is ridiculous turnover. Tiny float too, about 534,000 shares, so this is exactly the kind of name where the candles can look clean for 30 seconds and then just rug you. The existing $2 line stays the gut check for me. If it keeps living underneath that, the squeeze tone cools off fast and it turns into churn. If buyers actually reclaim it with volume, different conversation. But right now, under 2, I'm watching whether the 1-minute starts printing lower highs. That's the tell. Momentum name? Yes. Clean? Not anymore. BCARU now, and this is a totally different animal than SCKT. This is a SPAC unit sitting right around that $10 zone, so don't treat this like a normal low float runner where every candle is clean momentum. Price says 10 bucks, up huge on the board. Volume's only about 188,000 shares, but that's still almost 200 times its normal volume because the average is basically nothing. So the read here is liquidity first. Are we actually accepting above 10 with candles holding there, or is it just widespread prints making the percent move look insane? For me, 10 is the line. Above 10 and holding, okay, there's at least some bid. Under 10, and this can get very noisy very fast. Now, STKH. This one's much more classic small cap momentum. Stakeholder Foods, 460-ish, up about 147%, and the volume is wild. 57 million shares against roughly 96,000 average. That's almost 600 times normal volume, and the float showing here is under 500,000. So yeah, this can move violently both ways. On the 1 minute, I'm watching the shape more than the headline percent. If it's reclaiming and holding the mid-4s, that's real demand trying to stick around. But if each pop is getting stuffed and the candles are making lower highs, that's where these tiny float names can go from runner to trap in like 3 minutes. 450 is the live pivot I care about here. Holding above it keeps the bounce alive. Losing it and you want to respect how thin this tape is. JWEL next, and this is where I want to be a little stricter with the read. Jowl Global, China specialty retail name, trading around 327, still up about 111% on almost 74 million shares. That's massive turnover for this thing. But the backdrop matters. Small float, high dilution risk profile, and this is not the kind of chart where you just chase every green candle because it's green. On the 1 minute, I'm watching the quality of the bounce right here. Are buyers actually stepping in around the low 320s, or is it just one lower high after another after that earlier squeeze? If 320 starts acting like support, okay, the bid is still alive. If it loses that and volume stays heavy on the red candles, then it's telling you the momentum crowd is rotating out.
Thanks, Markets Desk. Breaking macro tape right now. ProTerminal's newsroom is tracking an unexpected July jobs loss, with the U.S. economy shedding 23,000 jobs. That's the headline. Not a slower gain, an outright negative print. And markets are dialing back the near-term rate hike odds off that. What we know, labor demand cooled harder than expected in July. What we don't know yet, how much of this survives revision, whether this is one weird month or the start of a trend, and how the inflation side of the mandate lines up. The market read is pretty measured, not panic. SPY around 775, up 0.22%. QQQ up 0.16%. IWM is red by 0.31%, so small caps are not exactly throwing a parade. VIX sits near 20.10, down about 1%. Here at the macro desk, that's the split. Equities like lower hike odds, but a job loss print is not candy. It's lower rates math versus growth wobble math, and the tape is still deciding which one gets the bigger font. Next headline. The dollar falls to its lowest level since May as the rate hike question gets messier. The logic is classic macro plumbing. Fewer hikes, or even just fewer hikes priced into the front end, can take some support out of the dollar. Why it matters? A softer dollar can help overseas revenue translation for multinationals, but it can also lift import costs, so it doesn't solve inflation by magic. Sadly, the FX market has not discovered free lunch. Quick level check from our live cross-asset board though. The dollar proxy is around 28.13, up 0.2% on the session. So the intraday tape has a bounce, even inside that weaker, bigger picture headline. Gold's basically flat, around 398.66, which says this is not a full-blown safety scramble, it's more of a repricing debate. And third headline, Brent climbs about $1 as uncertainty hangs over the end of the Iran conflict. That's a geopolitical risk premium story. Supply risk fear gets a bid, and energy traders do what energy traders do. They add a little chaos tax. Why it matters for the broader market is simple. Oil higher can support energy names, but it also pushes on transport, consumer, and inflation-sensitive parts of the tape. Our oil proxy is doing more than blinking, around 123.15, up 4.38%. Crypto-linked risk is not loving the mixed macro backdrop either. BITO down 0.57%, Coin off 1.87%, MSTR down 0.43%. So the top-down picture is lower hike odds, yes, but oil hot and growth questions colder. Coming up, the markets desk jumps back into the movers board because apparently the single name tape didn't get the memo to be calm.
Thanks, MacroDesk. Quick check here at the Stock Whisperer Paperbook. This is the show's simulated paper trading portfolio, not something to copy. We're just grading the process. Unrealized P&L is around plus 613 right now. Cash a little over 80,000. TENX is still the driver. Short 1200 from 1.86. Last 1.495. Up about 438 on the position. CVX is clean too. Long 45 from 186.96. Last 192.10. Plus 231. MSFT is basically flat green. INTC is basically flat red. And Scion is the one pushing back. Short 800 from 4.13. Last 4.20. Down about 56. So the book's green, but it's not all perfect. That Scion short needs discipline. Orders tab, real quick. SION is defined. Buy cover target at 325. Stop at 462. For me, the live tell is 375 below. If that gives way, the short is confirming. If it rips back through 462, thesis is wrong and the bracket handles it. CVX still has the 195.50 sell target and the 189.40 stop. MSFT is 526.80 target, 502.40 stop, but I still want to see 515 before calling that AI chip headline real follow-through. INTC short stays boxed, 92.25 cover target, 125 stop. No new simulated trades right now, just managing levels. Coming up, Market Movers gets the tape back.
Thanks, Stock Whisperer. Alright, Markets Desk is back on the movers board. And yeah, this board is still completely detached from the index tape. SPY is basically flat, QQQ's a hair red, IWM's weaker, but look at these single names. SCKT's still sitting up almost 380% with ridiculous relative volume. BCAR-RU through that $10 area, STKH tagged the 450 callout, JWEL tagged 320, and our XHLD and ZJYL flags just hit 2. That's the scorecard. Nice. But now we've got to separate actual follow-through from just headline fireworks, because these are tiny cap tapes and they can flip fast. Let's go straight to SCKT first, because this is still the board monster. Socket Mobile at $1.85, up 379%, 81 million shares traded versus a 25,000 share average. Oof, that's not normal volume, that's a crowd. Float listed around 534,000, so this thing can move like a paper airplane in both directions. Here's the Markets Desk read. I'm not retelling the whole $2 story again. The live gut check now is simpler. Can it keep accepting above 180, 185? Or is this just churn after the giant squeeze? If it starts losing that 180 zone, the momentum crowd can get real impatient. If it keeps building candles above 185, then the bid is still alive. Fast tape, tiny float, medium dilution risk tag. Respect the risk on this one. Now, BCARU. This one's weird, so don't treat it like the same kind of runner as SCKT. This is a SPAC unit, D. Boral ARC acquisition units, sitting around $10.11, up 231%. The eye catcher is the relative volume, 222 times normal, but the actual volume is only about 218,000 shares, so liquidity matters a ton here. Look at that $10 area. Once it hit and started holding around 10, that's where people start paying attention. But with units like this, the spread can get nasty fast. So the tell for me is simple. Can it stay clean above 10, or does it slip back under and turn into a liquidity trap? Alright, back to STKH, because that 450 callout did get hit. Nice little scoreboard moment there. But now we grade the follow-through, not just the tag. Stakeholders still up about 140%, price right around 453, and the volume is just absurd. 58 million shares over 600 times average on a float listed under 500,000. That's the recipe for violent candles both ways. So if this thing is real, 450 should start acting like support and you want to see dips get bought quickly. If it's just a gainer board squeeze that ran out of buyers, you'll see it reject right back under 450 and start giving back those breakout candles. Big difference between a level getting hit and a level actually holding. Next one is JWEL, Joule Global. And this is another monster percentage move, up about 127% at 352. But don't just see green and get excited here. The board has this tag high dilution risk, small market cap, about 2 million float. And the volume is absolutely ridiculous at 74 million shares, about 291 times normal. So now on the 1 minute, the question is super simple. Is this still getting sponsored by volume, or is it just late chase candles starting to thin out? Around this 350 area is the live tell for me. If it keeps accepting above there with fresh volume, okay, the ramp is still being defended. If it starts slipping back under 350 and the bounce candles get smaller, that's where these high dilution runners can go from fun to nasty really fast. Now let's flip to the ugly side. Scion, biotech washout, down basically 92%. That is not a normal dip. That is a full repricing. Stock sitting around 415. Volume over 20 million, about 43 times normal. So yeah, the tape is active. But it's active because people are trying to figure out where the damage clears. The reclaim attempt that matters, it's 450. If Scion can't get back above 450, then every pop is still happening below the prior pressure zone, and sellers are probably still in control. If it starts basing under there and stops making lower lows, that's different. That's stabilization, not strength yet. Big distinction. For now, this is a biotech gap down chart, so I'm treating 450 as the scoreboard level, not some magic line. Alright, last two on this board real quick. 10x first, because this is the other biotech disaster move. 10x is sitting right around $1.51, down almost 89%. 32 million shares traded, so yeah, there's liquidity, but it's liquidity after a trial miss repricing. The level is super obvious now. 150. If 10x is living below 150, sellers still control the tape. If it can reclaim 150 and actually hold it, then okay, you might get a bounce attempt. But I'm not treating one green candle in a down 90% name as a trend change. Now AUUD, different side of the board, up about 56% at 128. But look at the volume, 114 million shares, relative volume around 160, and dilution risk is marked high. So this is not a clean victory lap name. The tell for me is that 136/VWAP style area we flagged. Below that, it's still more trap risk than breakout confirmation. Above 136 with volume holding, then the character improves. That's the mover scan. Coming up, let's rotate off the chaos board and get into the next desk read. Alright, let's flip from the wild movers board into a real mega cap check. Google on the daily first. Okay, daily chart. This is a $2 trillion name, so when it chops, it matters. Google is around the 353 to 354 area, down a hair. Call it -0.25%. While SPY is basically flat green and QQQ is just a touch red. So it's not getting smoked, but it's not leading either. The bigger picture here is pretty clean. Monster run from roughly 290 up into that 385 area. Then oof, hard reversal. Heavy volume, straight back toward 317. Since then, lower highs, lower lows, and now this basey action around 350 to 355. Not exciting yet. The 20-day area near 349 is trying to act like a floor, but the 50-day zone up around 356 is still overhead. Here at the markets desk, I care about that squeeze zone. Can it actually reclaim the mid-356s, or does it keep getting rejected under that 50-day?
Thanks, markets desk. Top of the hour, quick market minute for anybody just jumping in. It's 11:02 a.m. Eastern, and the tape is doing that very annoying Monday thing where it's not really red, not really green, just making everyone work for it. SPY's basically flat at 773.61, up 5 basis points. QQQ's a little soft at 722.11, down 0.13%. Russell's the weak cousin here. IWM at 300.11, down 0.48%. And the VIX is lower, 20.11, down about 1%. So this is not panic. It's more like the market left one sock in the dryer and can't move on emotionally. The actual macro story is outside the equity screen. Bonds are lower. TLT at 82.29, down 0.57%. IEF at 92.90, down 0.30%. So yields are leaning higher, and that's why the Nasdaq isn't exactly throwing a parade. Dollar proxy is firmer at 28.12, up 0.18%, while the yen proxy is getting hit, down 0.82% to 57.77. Even if you only trade US stocks, keep an eye on that yen move. When FX starts yelling, equities usually hear it eventually. Oil is the loud one today. USO at 123.66, up 4.81%. Gold's barely green at 398.85. So this is more crude-specific stress than full safe haven panic. Crypto-linked risk is mixed. BITO down 0.57%, coin down 1.88%, MSTR slightly green. Here at the macro desk, I'm watching VIX around 20, USO holding the 123 area, and TLT around 82.30. Also on today's calendar, existing home sales, plus earnings names like DEO, IHG, and FUBO. Coming up, we've got another mover scan, a quick pro terminal hit, then right back to the tape.
Thanks, Macro Desk. All right, let's hit the movers board. Mixed tape underneath us. SPY basically flat. QQQ a little red. IWM weaker. VIX down near 20. So when this board is doing this is single name chaos, not broad market lift. Top of the board is still SCKT, up 354%, 84 million shares, relative volume over 3,000 times. That is not normal. Then PCLA up 138. BCARU also up 138 but giving us that SPAC unit weirdness. JWEL up 115 with huge volume. STKH up 113. And remember, that one already triggered the 450 scoreboard earlier and then slipped back. So here at the markets desk, we're not just cheering green numbers. We're asking, which ones are still accepting higher and which ones already trapped late buyers? Now pull up SCKT first, because this is the monster on the board. Oof, look at the scale here. $1.75-ish, still up over 350%, and the float listed around 534,000 shares. That's why it's moving like a video game. 84 million shares traded against that float. That is total churn. The clean read for me is still acceptance versus rejection. The prior marker on our board was 185. Right now, if it's below that, it hasn't really proven it can live back above the prior squeeze zone. If it starts building candles back over 185, fine. That tells you buyers are still willing to chase. But if this starts losing 170, that's where I'd say the momentum character changes again. Not a prediction, just the tape telling you the bid is backing off. And with a microcap like this, medium dilution risk on the data, tiny float, huge relative volume. You respect the move, but you absolutely do not marry it. PCLA next. And this is the cleaner test for me because it's not just some tiny $1 flyer. It's sitting around 19 bucks, up about 138% on the day. The thing I'm watching here is that 19 area. If this is real follow-through, you want to see buyers keep accepting above 19. Not just these big spread candles where it tags high, snaps back, tags high, snaps back. Volume's decent, about 1.9 million shares, but the board's relative volume is only 0.64, so I'm not treating that as the same kind of insanity we just saw in SCKT. This is more like, can it build a base above 19, or is this just widespread chop after the morning move? If it loses 19 cleanly and can't reclaim, I'd expect traders to start fading that momentum pretty quickly. Now, BCARU. This one's the honest follow-up because earlier that $10 area looked like the big excitement zone, and yeah, that failed hard. We're down in the sevens now, around 726. Still technically up huge on the board, but the character changed. That's the difference between a headline percentage move and a tradable tape. If you chase that 10 push, you got a nasty reminder of how thin these unit names can be. Relative volume is still wild at about 243 times normal, but the level that matters to me now is not 10. 10 is overhead supply. First thing is, can it even reclaim 8 and hold it? Under 8, this is still a faded move, with bag holder pressure above. Over 8, okay, maybe it stabilizes. But right now, the chart's telling you the sellers won that first battle. JWEL now. This one's still doing monster volume, but the character's a little different from the headline number. You've got it around 334, still up 100+%, 75 million shares, nearly 300 times normal volume. So yeah, the crowd is absolutely still here. But the level I care about is that 350 area. If 350 was the rejection and every bounce is starting to stall underneath it, that's lower high pressure, right? That's not the same as a clean continuation tape. For bulls, you want to see it reclaim 350 and actually hold above it, not just wick it and get smacked. Underneath, $3 becomes the big psychological danger zone. And with this one, tiny float, high dilution risk profile, you've got to respect how fast these can flip. STKH next, and this is the scoreboard check. Earlier, that 450 level got tagged, so the level mattered. But the acceptance failed. That's the honest grade. It's back near $4 now, still up over 100%. Volume is insane at almost 60 million shares, 600+ times normal. But once a low float runner hits the breakout spot and can't live there, you start judging the pullback way more aggressively. $4 is the line now. If it keeps dipping under 4 and can't reclaim it quickly, that 450 move starts looking like exhaustion instead of expansion. If it gets back over 4 and builds, okay, then you can reassess the tape. But right here, failed acceptance after a level hit is the whole story. All right, last sweep here. Quick hit on the red biotech tape, then the lower board rotation. SION first. This is just a full washout, around $4, down 90+%, 21 million shares traded. And I'm not going to relitigate the whole biotech story here. The only thing that matters live is whether $4 becomes a base or a trapdoor. If it can reclaim and actually hold over that 420, 425 zone, okay, maybe you get a cleaner bounce attempt. If it keeps failing under 4, that's still seller control. 10x is the same bucket, around $1.45, down almost 90%, huge volume, but the chart's gotta earn it. 150 is the clean little line for me there. Below that, it's still just heavy supply. Now flip to the secondary green names. XHLD at 360-ish, up 78%. That one still has the better bid if it holds the 350 area. WYHG, honestly, looks steadier to me. 780-ish, lower volume than the crazy micro names, but if it keeps leaning into 8, that's the clean momentum check. AUUD has the biggest headline volume down here, 116 million shares, but around $1.30 with high dilution risk. That's the one I'd treat the most carefully. If $1.25 starts slipping, the air pocket risk picks up fast. So my rank into the next rotation. WYHG cleanest bid, XHLD still alive over 350, AUUD most crowded and most fragile. Good scan. Coming up, let's shift off the chaos board and get into the next read.
Thanks, Markets Desk. Breaking Apple headline right now. Apple stock is falling about 2% after a Jefferies downgrade tied to concerns around the rumored all-glass iPhone. What we know? The concern is that the all-glass project has reportedly been scrapped. And that raises questions about the next high-end iPhone cycle, premium pricing, and margin pressure if component costs stay sticky. What we don't know yet, we don't have Apple confirmation on the product roadmap, timing, or whether another premium device takes its place. Market read from the macro desk, with SPY basically flat around 773.6. and QQQ only down about 0.14% near 722. A 2% Apple drop is not just market red, that's single-name sentiment getting repriced. The iPhone hype machine losing a shiny object is, apparently, enough to make the tape check its pockets. Next mega cap tech wire. Microsoft is tracking toward a fall unveiling for its Maya 300 AI chip, potentially as soon as next month. That matters because this whole AI trade is not just software demos and fancy slide decks. It's silicon, power, cloud capacity, and who controls the stack. If Microsoft can push more of its own AI hardware into the Azure ecosystem, that could help it compete more directly in infrastructure and manage parts of the cost curve. The thing we don't have yet is the real scoreboard. Performance benchmarks, deployment scale, and customer adoption. So for now, it's a strategic headline, not a completed victory lap. And staying with Microsoft, the other side of the AI ledger is margin pressure. The desk is seeing fresh research highlighting costs tied to AI investment and competitive dynamics. And that's the key tension for investors. Cloud and AI can drive growth, but data centers, chips, power, and talent do not show up wearing a discount sticker. With TLT around 82.29 and oil sitting up near 123.66, the market is not exactly handing out free capital this morning. So, the Microsoft story is really two-sided today. Bigger AI ambition on one page, cost discipline on the next. Coming up, the movers board gets another pass because the small cap tape has been acting like it drank the espresso machine.
Thanks, Macro Desk. Quick pit stop on the tools powering the market's desk. This is ProTerminal's movers board. Green, red, relative volume price, all in one hit. SPY's basically flat. IWM's a little heavy. So when something like SCKT is up triple digits, I want it on the board fast. But key point, this is a research board, not a buy button. It tells us where the fire is. Then we go find the smoke. Then, one click, boom, we're on the 1-minute chart. This is what we care about here. Where volume actually hits, where the wick rejects, whether the breakout sticks or just gets stuffed. If a mover is up hundreds of percent while the broader tape is mixed, I don't want the story 5 minutes late. I want the candles. Chart first. Levels next, catalyst after that. Now slide over here, dilution center. This is why the markets desk keeps yelling about shelves, ATMs, offerings, warrants. Small cap momentum can look gorgeous for 3 candles and still have messy financing risk sitting behind it. Then on the single name profile, filings tab, insider tab, I want to see what the company actually filed, not just what the tape is screaming. Data can be delayed or incomplete sometimes, sure. But this is the workflow. Verify, don't vibe. And the news tab is the same idea. Press releases, company updates, the stuff we check before calling a move real. This stream is educational. No magic button, no guaranteed trades. Just cleaner research. Movers, charts, dilution, filings, insider trades, news. Coming up, we're right back to the mover scan. And if you want the same setup we're driving live, sign up at proterminal.io.
All right, back to the movers board. Markets desk wants the live tape, not the brochure. SPY's basically flat. QQQ a little red. IWM still soft. So these single name moves are doing their own thing. SCKT is still the headline freak show. 172-ish, up 345%, 89 million shares. Relative volume over 3,400. That's not normal interest. That's a full crowd event. BCARU. Oof. This one already hit both sides of our scoreboard. Back above 8 but still below 10. Classic unit name chaos. JWEL and STKH both still green big, but STKH breaking that $4 line matters. Then XHLD, WYHG, PCLA, AUUD, all still on the board, but not all the same quality. Let's start with SCKT on the 1 minute, because this is the one the whole board is staring at. Tiny float, roughly 534,000 shares, and it's traded almost 90 million. So yeah, liquidity is there right now, but the structure can get nasty fast when everyone's in the same doorway. Current print around 172. The line I care about first is 170. If buyers keep defending that area, the tape stays alive. If it starts living under 170, that's where I'd expect the momentum crowd to get twitchy. Upside, I don't need to overcomplicate it. 180 is the next clean reclaim zone. Not a prediction, just scorekeeping. Under 170, pressure. Back above 180 with candles holding, better bid. And remember, on a move this stretched, the win is not chasing the headline. It's seeing whether the bid actually survives the next pullback. BCARU, next. And this is a weird one, so don't treat it like a normal operating company chart. It's a unit, it's a shell company name, and you can see why the spread and the candles can get nasty here. Current prints around 9.18, still up about 200%. But the scoreboard piece is simple. We flagged that $8 reclaim earlier, and yeah, that mattered. Above 8, buyers at least had something to work with. But under 10, it's still not clean acceptance. It's more of that whip both sides tape. So for me, 8 is the line where the move starts looking like it's losing the bid again, and 10 is the line where it has to prove it's more than just a headline unit squeeze. Now, JWEL. This one's way more liquid on the tape. 75 million shares already. Relative volume near 295 times normal. Price around 3.37, so this is not hidden. Everybody sees it. But here's the catch. Small float, tiny market cap, and the dilution risk tag is high. So when it starts trading heavy, you don't want to pretend that's just normal profit taking. The $3 area is the spot I care about on this chart. If it's building above 3, then the lower highs start easing. Okay, that's stabilization. But if sellers keep leaning every bounce and it starts drifting back toward 3, that's when this can turn from momentum into a crowded unwind really fast. Big volume is great when it's lifting. It's brutal when it flips. STKH now. And yep, this is the follow-up we wanted. That dip under $4 did trigger, so the question now is super simple. Was that a flush and reclaim, or does 4 turn into the ceiling? It's sitting basically right on it, around 401, up 113% on 60 million shares, so the tape is still crowded. But don't ignore the structure here. Floats under 500,000, relative volume is over 600 times normal, and with a microfloat name like this, private placement and dilution risk are part of the whole setup. So I'm not chasing the headline. I'm watching whether buyers can actually accept back above 4. If it pops over 4 and holds, okay, that's a reclaim. If it keeps wicking into 4 and failing, that's supply showing up. XHLD next, and this one's cleaner than some of the chaos lower on the board. It's still a small cap momentum tape, don't get me wrong, but the bid quality here looks a little less random than the unit name we checked earlier. Price is around 409, up about 102%, 34 million shares traded, and relative volume's big but not totally cartoonish at 31 times. The open callout is still 350. That's the line I care about for whether this is constructive consolidation or just a slow rollover. Above 350, you can at least say buyers are defending the prior lift. Lose 350 cleanly, especially on expanding red volume, and the character changes fast. For now, this is a watch the base chart, not a victory lap chart. WYHG first. Quick momentum check here. This is still up about 88%, but it's not doing SCKT type insane volume. We're talking about 2.8 million shares, roughly 21 times normal. So for me, the clean read is $8. If WYHG can keep accepting above 8, fine, momentum traders still have something to work with. If it starts living back under 8, that's where this can turn into one of those late-day air pockets. Now flip PCLA. Totally different feel. It's still green, still up big on the day, but relative volume is under 1 times normal. And it's fading away from that earlier 19 acceptance line. That matters. If a stock runs, fails to build above 19, and then starts drifting at 15-ish, that's not strength. That's a failed acceptance move. And last one, AUUD. Monster crowd here, 117 million shares, 164 times volume, high dilution risk. So I'm not marrying this tape at all. The only question is whether it can stay out of the danger zone in the low 120s. Above there, it's still tradable chaos. Lose that, and the crowd can run for the door fast. All right, mover's board is mapped. Let's widen back out and hit the next piece of the tape.
Thanks. Markets Desk. Let's slow it down for an earnings spotlight on Diageo. DEO is not doing the small cap fireworks thing, right? This is a roughly $54 billion spirits giant, trading around 96.80, up about 0.5%, while QQQ is a little red and IWM is weaker. That's actually the setup. Defensive stock, quiet tape, earnings on today's calendar. The 1-minute chart is a grind, not a rip. Base around 96.15, day low just above 96, and buyers have walked it up into 96.83. Basically right under the day high area. So for me, above 96.83 is where the tape has to prove acceptance. Below 96.15, that intraday earnings bid starts looking tired. Here at the company desk, the question isn't just, is the stock green? It's what does this print actually change? Diageo is Johnny Walker, Guinness, Don Julio, Casamigos, Smirnoff, Captain Morgan, a global alcohol shelf. The latest financial snapshot we have shows revenue around $10.4 billion for the December quarter. And the growth line is the important part. Revenue down about 5% year over year, but EPS growth up about 13%. That's the whole story in one sentence. Top-line pressure, but earnings still being protected. TTM gross margin is near 59.5%, operating margin about 28%. So I care less about a headline beat or miss in a vacuum, and more about whether management can show premium spirits demand is stabilizing. Let's hit the news tape, because I want to see if there's a fresh catalyst sitting behind this. And honestly, the recent DEO feed is mostly brand-level stuff. Smirnoff Ice promos, a Blade & Bow limited bourbon launch, Captain Morgan product pushes, plus an AI and data governance event. Useful color, sure, but not the kind of headline that usually rewrites the earnings model. So if the stock reacts today, I'd anchor it to the actual numbers and commentary, not the marketing press releases. The calendar has DEO on today with an EPS estimate of $2.51, but I don't have a confirmed release time in this feed. So this can turn into a headline gap name pretty quickly. One more layer before we move on. The balance sheet matters here. Last snapshot has total debt around $24.2 billion, net debt about $22 billion, cash around $2.2 billion. For a staple-style global brand house, that's not automatically scary, but it does mean rates and cash flow conversion matter. Free cash flow in the last reported December period was about $1.5 billion, lower than the prior December snapshot. Analyst tape is mixed too. UBS moved from buy to neutral late last year, while BofA had maintained buy earlier. So yeah, not a clean consensus love story. I'll bring the chart back. 96.83 to 96.89 is the acceptance zone above. 96.15 is the failure line below. Coming up, we'll kick it back to the movers board and see where the live money is actually rotating.
All right, that's it from the markets desk. Mixed tape, messy breadth, but the levels did the job. WYHG paid above 8. SCKT lost that 170 area.